Hey everybody, this is Jose Blasco. How are you everyone? Sound check before we start the session. You're gonna get a quick confirmation on the chat box. A quick hello would do. So I know you hear me, I know all is good with sound, and we are ready to get started. So please give me that confirmation while you say hello to your traders mates. And that way we begin on time, everybody. Thank you so much. Just a few seconds to go here. Here we go. So we are now live, and it seems all is good with the sound and everything else. Thank you very much, everybody. Let me turn on the video stream as well so I can say hi from the bottom right corner, as I always do. How are you, my friends? Good to see you. Welcome to the session. Let's begin. How are you, Joe? Good to see you. And actually, we're going to start with your question, Joe. Very good. Anyway, everyone, welcome to the session March 3rd, 2021. Options with options. Options give you options. It's beautiful as an asset. We can really adapt to the market conditions or the trading styles or both, given the various ways on how to approach trading with options trading. Okay, so we're going to be enjoying it in the session today. Before we get started, disclaimers. Let me highlight it so all of you can read it carefully. Please read it carefully. Every word. It's just a couple of paragraphs. Don't miss it. It's important stuff. It's pretty summarized if you wish, but it's really relevant. Thank you so much, everybody, for looking into it. So agenda for today, as always, we start with a hello. I think we already did that, isn't it? So then I just wanted to let you know, of course, the ones of you that attend the sessions regularly, you know this. We are simulcasting. What does that mean? We are running our stream in multiple places at the same time. So there are a few things to be kept in mind. First of all, I'll start with the bottom bullet point. The chat box. How are you, Maka? Good to see you. The chat box may have some latency depending on where you are and which channel are you connected. It could be Facebook, it could be YouTube, it could be our private room, etc., etc. So keep that in time. Keep that in mind. If you have questions for me, or if I have questions for you, let's jump on those chat boxes as soon as possible. So that way there is no delay, or we suffer the least delay as possible. Second, let me see. Yeah, there may be slight differences with the delays depending on where you are. How are you, Ahmed? Good to see you. So let's say, for example, you are attending this session and you are utilizing YouTube. You may have 5, 10, 20 seconds delay. Maybe you're using Facebook and you have 25 seconds delay. Maybe it's only 3 seconds delay. Maybe it's 8. So every channel has different delays because of the nature on how the broadcasts go out there. Okay, so just keep that in mind. And finally, as well, the fact that we are running some of our content in public spaces such as YouTube or Facebook and other, but we also have our private room. This means that in order to keep everybody happy, we have in the community, we have traders that are looking at trading, let's call it part-time. We also have traders that are looking to trade, let's say, looking to be a super trader. Okay, way to go. So of course, it's all about quantity, right? So the ones of you that are looking at trading part-time, probably you would appreciate if the sessions are 20-minute long, 30-minute long, where the ones of you that are looking to be those super traders, so you never got enough. You are so passionate about trading, you always want more, right? So in this sense, to accommodate everybody, so we are running longer duration sessions in our private room, and we are running shorter duration session in our in the public environments. Okay, so the quality of the content is the same. It's not like I always say we don't keep a secret sauce or anything like that. There is no secret sauce, my friends. It's all about discipline and doing the work well done. That's how you trade. So we are just as committed to support you in the same way in the public or the private rooms. But just know that in about, let's call it 30 minutes time, or once we accomplish finding our first trade of the day, we will then disconnect from the public spaces and remain trading and learning in the private room. Okay, so everybody knows that, and therefore let's begin. So we're going to look at the market, look at the trades that we have open, and then look at new opportunities. Little exception today, actually 2 little exceptions today. We're going to start looking at a question from Joe, which I could not answer properly in a written form. and therefore I wanted to answer this question in the room so I can be visual for the explanation. So Joe, thanks for your patience with me. Also because on Monday in the end I was not able to conduct the session, so you had to wait a little extra. And then on the other hand, today is March, is the first session of March, and as I explained last month, we're gonna start with more option sessions and getting into content and techniques that we have never explored together, just because we didn't have the time, because we were running one session a week, and that was it. So we've doubled the amount of time for the sessions with options, and that's going to give us more flexibility to do more stuff, and we're going to start with that today. Okay, cool. Okay, so let's begin, guys. A little bit of a long introduction today, but I had to. Anyway, so here is TradeStation. Again, you may be surprised. You may be, hey, Jose, wait a minute. This is the futures workspace. This is not the options workspace. And you're right. And this is because I need to answer a question for Joe, which has to do with the ATR and how to control the processing power of TradeStation if you're running many charts at the same time, while you get enough statistical data when loading AutoClimate. Okay, so Joe's question in the end can be summarized very quickly, which is how many candles you load when you are running AutoClimate. What's the minimum, right? Because the least the better to reduce CPU usage, right? So, well, notice that on my charts, I'm using 500 bars if I'm doing intraday trading, and if I'm doing longer term trading, like options trades and so on with a daily time frame, I'm loading 2 years of data, which every year has 252 trading days. So if you think about it, that's also about 500 candles. So this is my bare minimum. Okay, this is my bare minimum. In a perfect world, if your CPU allows to, and again, it's not only about the CPU, really, the nature of the architecture of TradeStation limits some of the usage of your computer resources. So you may have a super computer, and someone with a normal computer may run TradeStation more or less at the same level, just because how the architecture of TradeStation is. Okay. So keep that in mind, and that's why it's always good to reduce the amount of candles. But if you were to be able to afford it, so test it, okay, I would say the ideal place to gather proper stats, which are, I would say, at its peak of relevance, would be around 1,500 candles. That would be perfect. 1,500. That would be perfect. Again, if you run too many charts, it's just not possible. Okay, so what do? Then drop it to 500. Okay, that's the second step. You will get a little less reliability with the stats, but I would say it's good enough. Now, let's say you tell me, but Jose, wait a minute. I am that super trader you're talking about, and I have like so many charts and so many monitors that is no way I can do not even 500. For TradeStation not to freeze, I need to do 100, and 100 is not relevant enough from a statistical point of view. So what's my recommendation? Well, my recommendation then is that you use TradingView. Use TradingView for the AutoClimate in a separate window. Okay, use TradingView with AutoClimate in a separate window. You can connect your TradingView to TradeStation. So you get the market data from TradeStation into TradingView. So you have real-time data on TradingView, and do the AutoClimate on TradingView while you do your AutoUFOs and everything else on your TradeStation. That would be my recommendation. And and that's what's possible, because in the end we are limited by the processing, which is what it is. Okay, so Joe, I believe this should answer your question. Let me know if that is not the case. I'm happy to elaborate more, but again, in my mind, this should answer your concerns. And by the way, your questions, Joe, I love your questions, my friend, because they really show the time and effort you're putting into this. So way to go. And again, congratulations, because it's the way to master trading. Okay, there is no secret sauce, as I said before. Anyway, you got it. Thank you. My pleasure, Joe. Very good. So let's continue, everybody. We are gonna look at the market first. So what's going on with the S&P? Oh, interesting. I got a weird auto climate there. So let me switch time frame quickly. Okay, go back to the daily time frame on the SPY. Here we go. So what do we have? Okay, well, as you can see, recently it's been tough. Okay, from a consistency point of view for the markets, there's been a couple of red dots, unconfirmed climate, another couple of red dots, unconfirmed climate, another red dot. What's going on? Okay, well, what's going on is that the world is difficult, isn't it? And I mean, using a little humor where really it's not so funny. And the market is trying to decide, I'm going to continue and start making all times high again, which makes absolute no sense from a fundamental point of view, but it doesn't matter because the markets work because of on-field orders, which are not related to fundamentals, or not always related to fundamentals. And like people have a job, get a paycheck, get some of the money in a 401k plan. 401k plans are made of mutual funds are made of stocks. Next thing you know, just because people are employed, so then money keeps coming into the market, no matter what. So again, fundamentals are relevant to a certain degree. On-field orders are the direct force moving price in the end. And so again, the market is having a tough time deciding what to do because of those two contradictions I kind of put on the table by explaining what I just explained. Okay. So again, we need to see what's going to happen right now. If we rely on what we should, which is stats and objective data, we are in a down climate. It's confirmed. We have a relevant price point again, 386.73, and this is not really lining up with those UFOs. Okay, but again, when you look at the SPY, you really have a very partial view of the markets. If you were to look at futures at ES, for example, it will give you a much better understanding of what's really going on, which is also a confirmed climate to the downside with a relevant price point around 38.70, and around that price, guess what? We do have on-field orders to sell. So the expectation will be the market to come here and continue falling, at least for a while. Statistics suggest 3 days, up to 3 days. Okay, and this is today's day one. So we could see the market go down for a little more. Keep that in mind. On the SPY, you can also see green UFOs located a little lower, which it may take 2 days to get there, which is what the climate would suggest. So again, statistics suggest to be thinking short more than thinking long. So no hope for stocks you may own or positions you may have. Just act on your plan and be disciplined with whatever information you got on the screen. Don't add human emotions to it just because maybe you like very much that company you just purchased last week and now it's moving against you and you're hoping, okay, the climate has been, kind of, not consistent here. So hopefully it's going to go back to blue now. Right? So, well, yeah, I understand that thinking if anyone is thinking this way because we are all human, but that's not how we should be thinking as traders. Okay, as traders, we should be like the UFOs. We should be more alien and less human, if you wish. Not sure this is a funny joke, but you get my point. So, from a volatility point of view, you can see we are now hitting 25%. So certainly some fear is kicking in, and that is definitely aligned with the comments I just made as we started the session, isn't it? Now, let's review the trades that we have in place. Now we understand better what we got going on in the marketplace. So first of all, we got an Iron Condor running with Facebook, which we already commented last week that this is a trade that could have been closed already. So I will let it go all the way to the end because this is a trade that we planned, in the prior months. But starting from now on, we're going to have more what-if scenarios for trade management, evolving positions during their life, switching to what I call damage control mode, all of those things that we need to learn and discuss together, which we will. But for now, as you can see, so the Iron Condor is in the purple area. We planned the trade that was February 4, planning for the trade to be running until March 19. So we still got, let's call it 2 weeks to go, 2 weeks and a little more to go. We are still in the purple area. If we were to assess um, with Option Station Pro if it makes sense or not, or if this trade looks to be, a likely trade or an unlikely trade to work or not to work. So looking at probabilities, okay, here we go. Okay, it's loading. So I'm just gonna load Facebook. You can see so far we got $30 of P&L with that trade. Why? Because we are still in the purple area. We have accumulated a lot of time decay, which again, that was the reason why last week we could have closed it already. But again, I'm just gonna keep going. So in the analysis tab, notice that if I check mark the Iron Condor on Facebook, it says that one standard deviation above and below, it's 278 and 241. Okay, so 278 and 241 means that basically that line is more or less where it was last time, and 278, it's more or less here. So what does it mean? That, statistics suggest that from now until March 19, we're still going to end up somewhere in that purple area, within the purple area. So we should be fine. And we still have UFOs to defend ourselves above and below. So again, really holding this trade and doing nothing about it makes sense. So the original plan makes sense. Even though again, I'm eager. I'm just repeating myself, but I'm really eager to get deeper into more option stuff with you guys. So again, this is for Facebook. And when it comes to Dow, anyone with the Dow trade, by the way, because we planned that the other day, so I want to make a few comments. So the trade is working fine. This is a directional trade. This is not a non-directional. That one is directional. So we planned the trade. It was 225. We needed Dow to hit 60.73, and it didn't on that day. Okay, but the very next day it did. Okay, so the very next day it was on 226. Okay, and if I was to look at 226 right there, so our reference value was 60.36, okay, which is a little below this value, of course, okay. But again, if I go back to what we had at that time, to 1 second, guys. So 226. So I'll look at 225 the day before, right? So we had a UFO there all the way from 60.30 to 60.19, and another UFO below. Okay, so all that area was going based on the climate and how the markets work. All that area was, providing probabilities for us to end up in a good position, and that's what happened. Okay, it's not what always happened, but that's what happened in this case. If you did buy that call that we planned, so you would be in a profitable position. So what to do now? Okay, what to do now? Well, the right action to be done from a trade management point of view. You are in the trade, Maca. Well done, very nice, love it. So the right action to be done now, and I'm just going to use a different color. I'm going to make it red. I'm going to make it dotted line. So the right action now would be to focus on that 60.34, and I also want to look at pre and post market to see if something is around that price level. No, there is nothing around that price level. So by looking at regular session data, looking at that 61.34, so then it would be good to go ahead and set an alert, okay, which my favorite way to set alerts is with TradingView, because those alerts are on the server side. So if your computer is off, you still get alerted. You get push notifications on your phone, emails, whatever you set up. So it's pretty cool. And again, the expectation given the climate, which is still blue, right? So 2 out of 5, okay? So the expectation is that the market will keep going, okay? Probably goes through that UFO and start making all-time high, which is what we are looking for in this trade. That's why we bought a call, right? So that's it, okay? So now if it goes down and it crosses below this dotted line, so then of course staying in the trade implies hope, because what should happen is not happening. And therefore, the idea would be that you close the trade, probably for a tiny profit, probably break even, maybe even a little bit of a loss because of slippage. But that would be the right action. Okay. So now I would like to add another option here when it comes to trade management, which is that the fact that we have a UFO on the other side. Okay, so that UFO has a starting point located at 63.68. Okay, 63.68. So take a look at this. Okay, I'm gonna move to Dow. I'm gonna type 63.68. Okay, 63.68. By the way, Maka, since you are in the trade and I'm not, would you mind to share which price you got filled at when you bought that call? And also, I am assuming that you bought the 65 call that we planned. I'd love to know that if you could share. You don't have to share, obviously, that's quite personal as a question. But if you are open to share, that would be certainly something very useful for what I'm about to do. So now, why am I looking at 63.68? Well, I'm looking at 63.68 because of the following. So we purchased that call and we paid, let's say $2. Okay, and if the market goes up, okay, if the market goes up, okay, so that call will gain value. Now, thank you so much, Maka. This is very kind of you to be willing and open to share. So at 60.73, okay, at 60.73, let me add. Okay, at 60.73, let me do this. 1 second, guys. Just sorting things on my chart. 60.76. I think that was the price. Yeah, 60.73. So at 60.73, here we go. So we would expect that option to be worth, $145, something like that. Of course, that's theoretical. The market has been going up, so volatility went down. So probably it was more. Probably Maca paid more. You pay 134. Oh, very nice. The price was lower. It was at 59. Got it. Because, yeah, of course, that there was a very strong day to the downside. So you got a very good entry. Very good. Very good. Okay, so let's do this. We're going to use your values, Maca. So we went ahead and we got 134 at the entry here. So I'm just adding that price manually. Okay, which implies that at current price, okay, you have a theoretical P&L of $80+ on this trade so far. Okay, more or less. And again, this is options trading, so when you close the trade, you may get some slippage. So it may not be exactly that value. That's why it's theoretical, but it's about that number. So now, knowing that you paid 134 for this option, okay, here, and knowing that you are not in a spread, it's just a naked call. Okay, it's just a naked call. What's the beauty of a naked call? Well, the beauty of a naked call is that, if this thing goes to the moon, you're gonna make unlimited amount. Okay, what's the concern though? The concern is that while if it breaks that UFO, which it should, because the climate is up, right? Everything is gonna be good. Well, the reality is that if it doesn't break the UFO and price goes back down, okay, if it doesn't break the UFO and price goes back down, we may be in a situation where we already exceeded what probability suggests when it comes to autoclimate, and now we go from blue to red, and next thing you know, this market goes down and needs to hit all those UFOs here down below to someday in the future start making all-time high again, which means that now you're being killed on time decay, and again, it's not gonna be a good thing. So that's why we got the red dotted line, where if that was going to happen, probably it would be a better choice to exit at 61.34, where if that was to happen today, 61.34 would still give you a tiny profit of $30. Again, in your case, Maca, you entered lower, so that's why you get a profit. For most people, it would be break even or tiny loss. Okay, so you will want to take that tiny loss or break even and just get out and replan a new trade. There are 9,000 stocks in the US market. Let's find a better one. No need to be emotionally attached to the trade. Okay, but what happened is that instead of going down and hitting the red line, what happens? The market goes up, okay, and reacts to the UFO and starts going down. Okay, so this has consumed time. It's using more of the time and the probabilities of the autoclimate. It's increasing the probability of a climate to start working against you, and therefore increasing the probability of this going very deep against you. So how can you maybe try to lock in profits a bit more efficiently, apart from the option I just gave you, which is to exit at 61.34? How can you maybe do something a little better? Well, I would like to look at the possibility of doing two things. So one possible action, okay, let me write it down because this is going to be a bit advanced, okay? So again, it's March, my friends, be ready, okay? So one possibility would be to go ahead and convert, okay? So option one, convert the naked call into a spread, using a smart approach. I'm going to show you what I mean by that in a second. But what is the other possibility? Well, the other possibility, okay, would be to assess, and maybe we get a yes, maybe we get a no. The other possibility would be to assess if maybe we can sell two calls with a shorter expiration date. Okay, that would create a time ratio spread. So that's a pretty complicated option strategy. But really, I will not be doing it for me to trade a time ratio spread. I will be doing it for me to actually use the credit from those calls from a shorter expiration date to go ahead and buy a put from the same original expiration date, meaning that now I have some sort of a strangle where if the market goes up, I make money. If the market goes down, I make money too. Okay, and that put is being paid by those short duration calls. Again, this will not always work. It depends on the volatility available at the moment because we are dealing with two different times. The day you took the trade, where volatility was probably very high, Maca, because the market was falling hard, and today, where probably the volatility is not as high. So we're gonna evaluate those two possibilities, and we may get two no-goes, we may get two go-aheads. That's the thing with options, that we not always get the trades approved, but if the trade is approved, next thing you know, you're gonna find yourself out of risk, and now no matter if the market goes up or down, you're gonna make money, which is very nice. Okay, again, not guaranteed that this is gonna work, but we're gonna look into it because it's certainly worth it as an approach. Guys, could you please confirm that you are with me with what I just said, even though depending on your options understanding and experience, it may be very confusing. I could understand that, but I would like to know if I was very confusing, putting on the side that I'm going to implement it and this will clarify. So thanks for those answers, guys. So anyway, I'm gonna start with number one, which is to convert the naked call on spread. Okay. So again, how did we do the spread? Well, what we did is that we purchased. Okay. So this trade is done by buying the 65 call. Okay. The 65 call that expires on, let me make no mistake, April 16. Okay, so it's April 16, 21 expiration. Okay, so April 16 expiration. That's the option that Maca owns. Okay, very good, Mark. I'm happy to see that you like it. Love it. So now, so we got this option here, okay? And the idea is, how can I convert this into a spread? Well, to convert this into a spread, let me bring this down so I make some space on the chart. So I'm going to have to sell a call against. Okay. Now, of course, if I sell a call, let's say I sell the 70 call using the same April 16 expiration, the problem of doing that, of course, is that I'm going to cap the profit. Okay, which this being a all-time high type of scenario, we said is not ideal. Because we want to capture that potential, very, very powerful move. When markets tend to make all times high, they normally have this very, very strong push. Okay, but what's the issue? It didn't. Okay, it tried. It went to our entry point, started rallying, and when it was time to make all time high, not only it turned around, actually it gave us a UFO. So added on-field orders were produced at that price at that moment in time. That's a threat for the healthy, life of this trade. And that's why doing a spread, makes sense, because, yeah, you're gonna cap the total profit of the trade, but you have a reason why you do that. It's not like we are now chicken mode. Sorry for the word, not sure if that's very politically correct, but I'm sure you get my point. So it's not like that suddenly it's like, oh my god, now I'm scared, right? Chicken mode, let's sell a call against just in case. No, we have a reason for that, objective reason for that, which is the UFO and the possible exhaustion of the climate, which when going up should be 5 candles and is already been up for 2. So careful, right? That's the reason. So now, if I was to sell a call, okay, now I want to maximize as much as I can the profit. So I would like to sell a call as high as possible. If instead of the 70, I could sell the 80, that would be better. Okay, but of course, the 80 call would pay me less than the 70. So which call should I sell? Well, this is when this price point comes into place. 63.68, it's where the threat begins. As long as this starts going up, we are happy people. Now, the moment it comes into the UFO, that's where now we have 50.28% probabilities, to be precise, that it's going to turn around against us. So this is where the concern begins. So 63.68 is the value I want to input here, 63.68. And with that value in mind, I'm going to uncheck the call we have. I'm going to move into the options tab, go back to the same expiration date, which is April 16. Okay. And what I'm going to do is look at what are options above price that could pay me the same amount of money I paid to get in, which is $1.34. Okay. So $1.34. Of course, you would say, hey, it's going to be the 67.5. Yes, but this is with the stock trading at 67, 62.67. What if the stock goes up to 63.68? Well, maybe the 70 will do it. Okay, so let's try the 70 put. Sorry, the 70 call. Analyze sell a single 70 call. And now I have it here. Okay, and notice again, my call blue color is unchecked. The put, the 70 put with the red color because I'm selling it, is checked. Okay, and if we were to look at what is the expected value of that call, which currently is, did I say put before? I'm sorry. If I said put, I meant call. So the current value of this 70 call is 77 cents. But when we get to that reference price, it's likely going to become $98, which is unfortunately less than 134. Okay, so then I guess that the right way to approach it would be to use the 67.5. Okay, where if we use the 67.5, when we get to 63.68, which is our red UFO, the value of this option is going to be 161, which basically means that you paid 134 to get into the trade. You are now going to be paid 161, so you will be on a net credit of around $30. So no matter what happens, the worst case would be that you make $30. Okay. So again, if I was to simulate this, okay, I will just manually type 161. Okay. Let's say you get paid 150, just to be a little pessimistic. So you pay 134 for the call, you get paid 150 for the 67.5 call. So now you are on a net credit of about $30, to be precise. The net credit, no, actually is $16. So worst case, no matter how low the stock goes, even if the stock goes to zero, you will make $16. Now, if the stock goes higher, okay, and the higher it goes, the better. But of course, if it surpasses 67.5, no matter how higher it goes, okay, the more you would make is that value, okay, which is about $200 over dollars, to be precise, 266. Okay, that's the most you will make. Okay, but that's a great one because you cannot lose anymore. So yes, you cap your profit, but you cannot lose anymore. So it's a risk-free trade that no matter what is going to pay you up to 266, depending on where the stock is on that expiration date. So this would be a good way to remove the concern and the risk, assuming the market will give you a little extra push and reach that UFO again. So again, option number one, from a trade management point of view, it's to go ahead. We could not do the 70, unfortunately. We're going to have to do the 67 and a half. I thought we could. I thought it was looking like maybe, but in the end it's not. So option number one, convert the naked call into a spread. Smart means by selling the 67 and a half call when Dow hits the red UFO at, we said, 63.68. Okay, so this would be one way to go ahead and take your options trade, and now you are out of risk. You cannot lose in this trade any longer. So before I keep going with the second approach, I would like to get your feedback. How is it going so far? Did I lose you? Is that easy to follow? I guess placing an order, if you understand how to do it, if you understand the concept, I guess placing an order is going to be a piece of cake for you. But if you need support on how to place an order for that, let me know. I'm happy to show, even though of course it would impact the rest of the session with other trades and stuff. But I'm here for you guys. So you guys let me know if you are following and you need support on how to place that type of an order. Okay, everybody seems to be okay. I'm just looking at the various chat boxes and everybody seems to be okay. Okay, good, perfect. Okay, so let's continue. Let me go ahead and explain number two. Okay, and after I explain number two, we will then continue in the private room and we will disconnect from the public spaces. Okay, Maka, yes, so we'd sell the call when price gets to 63.68. Correct, absolutely. That's the trade. Okay, so you bought a call a few days ago. Now you would sell a call when the price hits the red UFO at 63.68. Next thing you know, you are left on a spread. What's the beauty? The spread creates a credit for you. Even though it was a debit spread, you actually made it a credit. The most you would lose, or the worst case scenario, if you wish, would be to make $16. And then the most you will make is $266 if you were to get the exact numbers I got on my screen. Okay. Cool. Okay. Now, case number two. Okay. Case number two. Okay, is similar, but not the same. Okay. So instead of just doing a spread, okay, so the idea is gonna be, okay, we start from the same place. Okay. So we have the 65 call. Okay. That's the same story, but the idea would be to buy a put, probably somewhere below, okay, to create a long strangle. So if the market goes down, you make money. If the market goes up, you make money. Of course, a long strangle is a very difficult trade to make money because you need a major move to happen and volatility to not to drop. And if you were to do a strangle from the beginning, it's a tough one. But if you do it by legging into the strangle, meaning you got into the trade, the market moved your way. Now, same triggering price goes back to the UFO, and now you are concerned. Now it's like, okay, is it going to be all times high or is it going to fall against me, right? So that would be the time to buy that put. Now, if you were to buy a put at that time, okay, of course you have to pay for it. So now you pay for the 65 call, now you pay for the put, and now you're going to be in a double the risk trade, right? Because you pay for the call and for the put, so your cost is double. And while it's very smart because you legged into the strangle, still, the trade may not work at all because you paid double the premium and now you suffer double the time decay, and again all the disadvantages of doing a strangle, even though you legged into it, which is nice. So how can we remove some of the pain that a long strangle would provide? Well, we're gonna sell two calls. Okay, we're gonna sell 2 calls. Okay, but we're gonna use a shorter expiration date. Okay, shorter expiration. Why? Because I mean, could you do with the same expiration? Yes, of course you could. But then you got a problem. You are you will find yourself short naked a call. Actually, depending on the account on which you do it, if you are doing this in an IRA account or an account which is cash account or something like that, you may have to buy a call on top of this, so you are not short naked a call. Okay, and then that would be technically speaking, then that would be a butterfly, which is a time butterfly, and then you would have a long put below. So again, it gets quite complex. Okay, so if that's okay, since it's the first time we are discussing this type of manipulation on our options trades, okay, I'm just gonna assume that all of you are level 5, level 6 with your brokers, and it's okay for you to be naked a call. But at the same time, I don't want you leave. I want to leave you naked one call the least amount of time as possible, and capture as much theta as possible, because the pain of being long a call and long a put is that you lose theta. So I want to use a shorter expiration date to capture theta at the greatest rate as possible, and hopefully, actually, those options will expire before that major move happens. Okay, so the idea would be that the stock goes back up, hits the UFO, and what do? You add the 2 calls, you add the put, and now if it goes up, you profit. If it goes down, you profit. Okay, but if it goes up too much, one of those naked calls is going to be painful. Okay, the risk profile will look like that. I mean, I will show you the risk profile, but it will look something like that. Okay, so if the market goes down, you profit. If the market goes up, you profit. But if it goes up too much, now you give your money back. Okay, it would look something like that. So that's one of the reasons why we're using that shorter expiration call, to not to suffer for a long period of time. Now, of course, depending on the premiums available, we may be able to make it work. We may not be able to make it work. Remember my comment before when it comes to option number 2 or option number 1. With options, you can always have situations where you have to decline it. You have to discard the trade because it doesn't meet your rules, or it doesn't allow you to accomplish the purpose. The purpose is I want to use those 2 calls to pay for the put. Okay, so my put is free. That's what I'm trying to do. Will I be able to make that work? I don't know yet. Let's try. So I'm going to uncheck everything. Okay, I'm going to uncheck everything. I'm going to go ahead and go back to April. Okay, look at the puts I got here. Okay, and the one I purchased was a 65. So I would like to look at what if I buy a put below. Okay, and I'm just going to be looking at 62.5 for now. So I'm just going to analyze and buy to buy a put. And the reason why I'm doing that is just so I have it here on my analysis tab. And I'll come back to this later. Very, very likely I'll have to use a different strike. Okay, but for now, I have that one there. Second thing I'm going to do is I'm going to look at a shorter expiration date. Okay, I'm going to look at 9 days and see what happens with 9 days. Okay, and I'm going to be looking at the trade I have and where the risk is. And really, my risk, if you think about it, really, it's price hitting the UFO, and then instead of going higher, it goes down, which is what we would expect from a UFO, isn't it? At least for a while. So the idea is to go ahead and sell an option above that UFO. Okay, so it's located in a price point where price is not likely to go. And by the way, we could do the same thing you would do if you were to plan any non-directional trade. So you could go ahead, and we are using 9 days to expiration, March 12th. We are willing to sell a call above price. Okay, so I'm gonna pick any call, analyze and sell, single. And why am I picking any call? Well, the reason why I'm picking any call, and by the way, guys, I know I'm doing this quick, okay? Just want to open your eyes, okay? This is the first time we're doing advanced option stuff, so just want to open your eyes to certain things, okay? And then we'll get more and more precise and, step by step and everything else. But again, I want to show you how the 65 call, for example, if you were to look at the 1 standard deviation, okay? It would show you 66 75. So in other words, if I want to use an option that is not going to be hit or theoretically be hit from now until the expiration date, guess what? We end up with 67 right there. Okay. Now, if I do this option, if I sell 2 of the 67s, they pay me 20 cents. So, I mean, if I get paid 20 cents twice, it's no way I can buy a put for $3. This is just not going to work. It's not enough premium. Okay. So I'm going to have to make some sacrifices. Okay. And in this case, since I have the UFO there and the top of the UFO is 64, so I am willing to be more aggressive. Okay. And if the 64 strike is available, which it is, I'm just going to go with the 64, which is a strike, which is going to pay me $1 full. And I'm going to do 2 of those. Okay. So 1 on 1 is $2. Okay. Now, by the way, these are the values now. Okay. These are the values now. The value that I will be using in a minute is the values for those calls when we get to our UFO, which in this case is going to be 270. So instead of 1 on 1 is 2, which is 200, 270 means that that call is going to increase value by $35 each times 2 is 70. Hopefully I'm not going too fast. You guys feel free to let me know if I am indeed going too fast. Okay. So what's happening? I'm going to collect the premium from 2 calls. That will produce a credit of 270. Okay. And with that 270 in mind, I'm going to uncheck the calls. And now I'm going to check the puts. Okay. And notice what happens if I buy the 62.5 put. That put will cost me $262. But guess what? If I buy that put while I'm selling those 2 calls, okay, really, it's going to be break even, okay, because I get paid $270, I have to pay 2 something, so minus $2, break even. I mean, the options prices are going to be fluctuating. We could certainly consider that doing this combination of selling 2 of the 64 call in exchange for buying 1 of the 62 put. This is kind of like free from a cost point of view. Of course, margin applies. You are naked 1 call, so margin applied. But then when you do this together with a call, so what type of risk profile do we get? Well, this is the type of risk profile that we get, okay? Which in this case is not going to be acceptable, and I'm going to try to fix it, okay? So the risk profile we get, okay, since the 64 call, I told you I was being a bit aggressive here. So the 64 call, I was being a bit aggressive. So because the 64 call is below the 65 call, let me write it down. So we are dealing with selling 2 of the 64 calls. Below that, we are long the 65 call that we executed before. And then below that, we are willing to buy the 62.5 put. This is the trade we are putting in place, okay? So what's the problem? The problem is that the moment I go above the 65 call, those 64 calls are hurting me. And that's the reason why the P&L is going down. And because the 64 strike is actually below 65, so instead of having it above 65, I should have it below 65, isn't it? So the angle of this line is very, very steep to the downside, which is really hurting the P&L of the trade. Actually, if I was to go below 65, actually I start losing money. Okay, so I've been too aggressive with the selection of the 64 call, and therefore I'm going to try to fix it, okay, by maybe using a put a bit further out, okay? So I'm going to go, instead of 64 or 65, I'm going to do 66. I'm going to do $1 above. Of course, immediately you can see how that helps a lot. Let me uncheck the long call. So how much credit did we provide me if I do that? If I do it, so it's gonna pay me 107. Again, careful here, guys. Don't get confused with that. So if I do it once, I get $55. If I do it twice, I get $110. right? So now instead of 200 over dollars, I got 110. So really it's way less premium, okay? But, let's see what happens if I can find a put at a lower strike, how much that put would cost me. The 60 would be 172. So that's still too much. 57 and a half is 116. Okay. So 116, it's similar to selling two calls and being paid 108. So there is very little difference. So let's see what happens if I put it all together. So what if I buy the 57 and a half put and sell two of the 66 calls with a shorter expiration date? And together with that, I own the 65 call. So what would happen to the trade? Well, take a look at this now. Now, if the stock goes down, basically I'm locking into like about $90. Okay, and if it goes down more, it's a bit less, but depending on how fast it happens, because it could be a bit more, 144 or 90, right? So in other words, if the stock goes down, I make money. If the stock goes bankrupt or drops a lot, I make a lot of money because I am long a put. Okay? Again, I got a long strangle, so I make money in both directions. Now, if the stock goes up, okay, and goes above the UFO, okay, so now I need to be careful because on the expiration date, which is March 12th, I will make 159, so that's fine. But if the stock was to rally too much, let's say the stock was to jump all the way to 75, so now actually I am underwater, okay, by $900. So that's a problem, and that's the problem of being naked one call, okay? So, of course, this is something to manage very, very carefully. Being naked one call is obviously riskier than not being naked one call. This is more advanced compared to the prior option I gave you, where you just convert a long call into a spread, and that's it, end of the story. This requires more action, including watching pre and post market action, and maybe even hedging the trade with shares. Again, this is dangerous and a very, very big downside. At the same time, if the stock doesn't get there from now until March 12th, so what would be the real outcome of this trade? Well, the real outcome of this trade is that you don't have the risk attached to the 66 calls anymore, and then the put you purchased was virtually free. So what is your risk now? Well, your risk is the original $134 that you had on the trade. That's the most you can lose, okay? But knowing that, that is only until April. What will happen now is at current price, watch the gray line, you have locked in around $250 of profit. The lowest point is here, around 188. You have locked in that. And if the stock moves and makes all-time high, you're going to make that killing. Okay, you're going to make a killing. Okay, $600, very, very good return on your $134 investment, 6 times more, right? Amazing. If the stock was to fall sharp, next thing you know, you could make a significant amount of profits as well. The issue would be that the stock remains sideways between 65, between the break-even points here, which is 56 and 66, more or less. If the stock remains sideways and time passes and passes and passes, what's going to happen is that the gray line is going to come down. Sorry, that was not properly drawn. The gray line is going to come down, and then you will need to close the trade. Just because nothing is happening, just close the trade and just keep, $150, $100, whatever, and that's it, you're done. But the beauty is that now, if the stock was to move very sharp again, you are back in business. You are not limited like with option one with the spread, where the most you will make was 266. You remember that, right? So again, this is a valid way to approach it. And but again, you have to be very active on managing this, because that's where the real danger comes into place. If the jump and the all-time high happen before March 12th, you may see yourself in a pretty negative P&L if you do nothing about it. You could do that too, Maka. You could do that too. I mean, in my approach here with a gamma scalping, in my approach here, I am trying to do everything with options contracts, trying to avoid the use of shares. The reason why is not because it's wrong. It's absolutely valid. The reason why is because unless you have a portfolio margin account, meaning that your account is above 125K and you applied for it and you got granted portfolio margin account privileges, then utilizing shares of stock is very pricey. You only get 2-to-1 leverage, isn't it? 4-to-1 intraday, 2-to-1 overnight. And then, really you tie up so much capital. So it's not as efficient as doing what I'm doing, which is using options contracts only. Okay, but you could certainly do that. And by the way, gamma scalping, if you're going to use shares, implies huge amount of maintenance of trade and trades, and then you will need to be on top of the trade even more actively than taking care of this potential risk. So it's I would say it's probably a bit too much, from a operational point of view. Okay, now it's not wrong. It's absolutely not wrong. Concept makes sense and it's doable and it's actually it's valid. Okay. So now, what would be another way to kind of be like, Jose, wait a minute, I'm very concerned about this upside potential risk. So what would be a way to, remove the problem? Well, buy a call above. Okay, just buy a call above. Now, if you buy a call above, it's going to cost you money. So let's do that. I'm just gonna add analyze and buy a call, and then I will adjust it on the analysis tab. So this. Okay, here we go. So, well, if we are selling the 66, of course, the call that we need to buy is, again, I'm going to use as a reference the risk that we have on the trade, which is 134. So one something dollars above, right? So above 66, I'm going to have 67 and a half, I'm guessing. So if I use 67 and a half, I'm kind of adding a risk above, which is similar to the risk I have below, right? But now what's the problem? Here. So what's the problem? Well, the problem is if I uncheck the put and I only leave the 63 and 66, right? So notice that the value, the money available at my triggering price condition, which is the red UFO, it's $99. Let's call it 100. So remember, our 57 and a half call costs 114. So, I mean, could you do this one? Yes, but I would say, just to be fair to the concept of the trade, it would normally be more adequate to go for the next one, which is the 55, which is way cheaper. Okay. Unfortunately, it's only $2.50 of trade price increment at that stage, and it's a bit too far, to be honest. Wait a minute. I need to reset that. Here we go. So it would be $74. Okay, and therefore. Yeah, I mean, the trade is gonna be, it's better than free, but that's problematic because now we are not gonna get as much as a benefit if the stock was to drop. So now notice if the stock drops, it's $52. It's much less pay compared to what we had before. Okay, but now we could afford the stock. The stock doesn't get us in trouble until we get to 67 something. Okay, where earlier, without those additional calls at 67 and a half, and going back to 57 and a half. So the pain started, much sooner. Well, actually, more or less the same, okay? But the angle, okay, the angle is much worse, okay, when it comes to the speed of losing money, okay? So yeah, so again, when I do this myself, to be honest, I prefer to ratio it instead of butterfly it, meaning those additional calls, this additional call is only one for, to mitigate some of the angle of the drop. It's something I don't like to use too much, because if I do that, I am willing to take the risk because, again, I see the UFO, I see the market climate, the auto climate telling me that we may reach the end of the climate. So I'm willing to take the risk, but of course you have to be on top of it, because if not, you can have something very bad happen to you if you are not looking at the market that day and it was just a 5% up day. So it could be very problematic. Okay. So again, obviously Option number two, okay, it's a riskier proposal. It has its benefits, as I explained, but it's a riskier proposal, and it will be done by selling two of the 66 calls, okay, using March 12, okay, and buying, we said the 57 and a half put, okay, using same April 16 expiration. So the beauty is that the moment the March expiration takes place, you are now left with a long strangle with the risk of a one call only, where you already got some profit built in, and therefore you are net in profit, and just don't get greedy for the time decay to just eat up the whole thing in case the stock was to remain still and not to move much, instead of just go either up or down with decision. So again, it's certainly a very valid action, way more complex than the prior action that we discussed, which is just to convert it into a spread, and you just leave it alone, and there is nothing else to be done. It really depends on your trading style. You know, what are your preferences when it comes to trading, keeping it very simple, making it more complex. It really depends on how you want to approach it. But you know, again, I gave you two choices. So what I would like to get from you guys as we conclude the session, I never got to disconnect from the public streams, by the way, which again, it's fine. You know, again, we are here to help, really. So, but in any case, I would like to get your feedback when it comes to, was this over the top? Did I go too fast? Was it too complicated? Is it what you're looking for? And therefore, I'm going the right way when it comes to doing more option stuff into the future sessions. How is it going so far? Wonderful, Mark. Kiss for me. Like it? That makes me happy because I'm eager to go deeper into options. I'm always looking for simplicity for everybody to follow, and certainly simple works. Okay, so you don't want to make things complicated just because. But at the same time, options give you options, right? So I mean, you can see the smile on my face. Very good, very good, perfect. Okay, got your feedback, everybody. Love options. Yes, Ahmed. Me too, my friend. Very good, everybody. Nice to spend time with you as always. See you tomorrow again. We'll continue with this. I didn't get to put a trade in place today, but we were discussing this one. Thank you very much, Mac, again, for not only being applied and practice what you learn and so on, but also for being giving and share with us your specific trading price and everything else. See you tomorrow, everybody. You guys take care. See you soon. Bye bye.